The market can stay irrational longer than you can stay solvent. This oft-cited quote or versions of it is attributed to famous economist John Maynard Keynes. However, its significance is often lost on investors who like to believe that the market downsides always come with loud warnings, or that the market index cannot correct 30% after having gained 50%. Such investors stop looking for cues of risk and mistake the frothiness in stocks for real upside. For that matter, even words of caution from the people managing businesses that have sustained for decades fall on deaf ears. It is rare to find insiders less enthusiastic about a business than external investors. However, when such rare admissions occur, it is important to take notice. Cases in point are the management conference calls post the June 2024 quarter results. Unfortunately, there were barely few managements that sounded super confident and optimistic about near-term earnings growth. Even as market buoyancy continues to thrill investors, company managements don't seem as excited. Here's what the management of L&T, India's leading engineering and infrastructure company with presence across diversified business streams, had to say. With the union elections behind and the likely political stability, the government's continued thrust on capex and business optimism augurs well for investment activity. However, the pace of infrastructure progress could slow down due to skilled labor shortages in certain sectors. Now, one can reason that the infrastructure growth is cyclical and therefore execution risks could be the norm. However, even the non-cyclical growth requires funding. And with banks in tight liquidity squeeze, that too seems difficult. Here's what the largest PSU bank, State Bank of India, had to say about whether banks will resort to extreme measures to improve credit growth. It should be the self-control mechanism for each of the entity. They will have to decide whether they should have the loan growth or they should not have it. One of the entities has already offered to sell part of the asset book. So I think these are the kind of adjustments which people will have to be resorting to. So the key worry is that despite market speculations, the underlying earnings growth that are supposed to drive stock prices will continue to deteriorate over the next few quarters. Investors chasing lofty valuations with the fear of missing out or FOMO need to be wary of the following risks before buying stocks. The key risks to lofty valuations. Too good to be true. Companies claiming to invest in R&D and capacity for diversification in new businesses could face significant hurdles. More importantly, in many cases, hasty attempts to diversify could lead to what is called diversification, DIWR. In other words, companies may end up putting good money after bad by investing in relatively low return businesses or buying poorly run businesses at lofty valuations. Therefore, there are chances that valuations factoring in a significant and profitable pivot in the company's financials could turn out too good to be true. Second, plans on paper. About a dozen homegrown startups have got successfully listed over the past 5 years. Nearly double that number are set to seek debut on the bourses in the coming years. You can track the recent IPOs and upcoming IPOs of startups in this Equitymaster link. However, the problem with startup IPOs is that barely few have the track record of earnings growth and sustainability to show. Most are still in the process of getting regulated, and many are handling or licensing technologies that are yet to find enough market. So investors must remember that the promises made in the IPO prospectus could remain on paper in case the company managements are not geared to tackle the obstacles. Also, overpaying for growth could be significant risks, as has already been seen in the post-IPO debacle of startups like Paytm and Zomato. Third, earnings management. We certainly cannot paint every high-growth company with the same brush. However, the pressure to report obscene growth numbers quarter after quarter to prevent market disappointment can take a toll. Even seasoned managements of large companies are known to fall into such traps. So it cannot be denied that at least a handful of high growth businesses are trying to manage their reported earnings so as to not disappoint large investors in the bull market. Such companies could, in the worst case, also end up stepping on the wrong side of law in their frenzy to please shareholders. Investors must not forget the cases like Vakarangi, Manpasand Beverages, or for that matter ILNFS to warn themselves of not going overboard for growth. Even auditor notes and AAA ratings of such companies have been no guarantee of sanctity. So companies with a history of managing earnings in the past should all the more be handled with sufficient caution. Finally, when story becomes fiction. Bulk of the action in stocks are in the primary markets these days. There are dime a dozen IPOs soliciting investors with their fancy stories. The SME IPOs in particular have fetched plenty of attention in recent weeks. Frail business models with limited or no visibility have been flying off the shelves in the SME IPO market. So even the market regulator has warned investors about not buying into these fictional stories too easily. So here's what you must remember. Just as the benchmark Sensex could rise from 60,000 to 80,000 to 1 lakh levels within months, a correction could take the index back to the older milestones. There's no denying that Sensex 100,000 is inevitable. However, the journey to Sensex 100,000 may not be a smooth one, and only the most rugged riders could finally reach their destination. Hope you like this video. Thanks for watching.